the examples. Hopefully you prepare the answer for that one. Okay, we're going to look at that. We're going to discuss on the examples. So stop sharing your attendance. So we're going to look at the examples at the end of your notes. At the end of the class again, I'm going to share with you the attendance. Okay, this is example that you have. Okay, done about this one. So now I'm going to proceed with the examples. So you're ready with this one? Okay. So we try to look at the example at the end of your notes here. Okay, so we're going to have this one. On 10th of January 2012, Tua Berhad acquired 30% interest in Kasturi when Kasturi return profit was 25 on the year 2012. Okay, so we're going to have here Tua acquired Kasturi. Okay, Kasturi on the year 2012. Okay, they have 35%. 35% means that this is associate. Okay, and then Ottawa also acquired interest in Jebat. Okay, 80%. Same date in the year 2012. Okay, and then the profit during this time, RE here was 100, and then the shares capital, if you look at the next slide here, your shares capitals in Jebat here is 500. So altogether net assets here will be 600 in terms of Jebat. For Jebat. Okay. And then on 1st of January 2018, okay, Jebat acquired 40% interest. Okay, acquired 40% interest in Kasturi. So Jebat acquired 40% interest in Kasturi here. So means that now indirectly. So indirectly, Tua have a control over Kasturi. Even though before this they only have 30%, do not have a control. But once Jebat acquired 40% in the year 2018, then Tua have a control here. Okay, previously Tua have direct 35%. Okay, and then on 1st of January 2018, when Jebat acquired Kasturi 40% indirectly, Tua going to have another 32%, which is 80 times with 40. So altogether going to have 67%. Okay. So this is the one that you analyze. You need to analyze this one. So this is information that we have here. So the information that you need to focus here about this one. When you have the dividend income, at the same time you have a dividend paid. So once you have dividend income and dividend paid means that these two things need to be eliminated. Okay, so be careful with this figure. Okay, and then the other ones you have profit after tax. The thing that you need to focus here is profit after tax. Okay, for both of the company here. And then the other things here is RE brought forward. So RE brought forward here is only 1 year. If you look at from the day of the acquisitions of indirect interest that we have here from Tua to Kasturi here, you acquired this one in the January 2018. So from January 2018, so going to have here is 60 here is already RE brought forward, which is the RE on 1st of January 2018. Because the ending here, this one is because this one is only for 1 year. So this one will be your RE at acquisition also. Okay, acquisitions of this Tua to Kasturi. Okay. And then you have investment in Jebat here is 500. So 500. And then investment in Kasturi here is 190. This 190, 80% for Jebat. And then 190 here is only for 35%. And then 240 here is the investment by Jebat in Kasturi when Jebat acquired 40% interest, which is on 1st of January 2018. Okay, other asset. The rest is other asset. Okay, ordinary share 500 here. This one is also 500 RE. This is one that you have. Okay, information that we have. Okay, so additional information before we look at the additional information, we look at this one, the policy here. The group policy is to measure the NCI at the acquisition. Okay, date at the fair value. The consideration paid by the parent company to acquire subsidiary company was based on the proportionate shares of fair value of a subsidiary company as a whole. Yes, subsidiary company as a whole. Okay, if you look at here, to acquire Y, okay, Tuah acquired Y, Tuah need to pay, how much Tuah paid here? 500, yeah? 500. And then you're going to percentage of shares that you have here is 80%. So divide by 0.8. Yeah? So you're going to have here is equals to 600. Yeah? Now how much you have here? 600. Sorry. 500 divided by 0.8. You're going to have 625. Yeah? 625 here is the value of the company as a whole. Yeah? Okay, sorry, I missed the check. Oh, sorry. We got the version. Okay, thank you, Najwa. Okay, so this is what you have. So this is the value of the company as a whole. I'll just repeat this one. Yeah? So the value of the company as a whole. So the things that we missed previously is this one. Information that you need to know here is about the dividend income, dividend paid. What you need to know here, because when you have dividend income and dividend paid, you need to eliminate. Other information that you need to consider here is about the RE brought forward. So RE brought forward here is 60. That one that you have in Kasturi here is the one considered as the RE at the acquisitions here, because this one is you acquired on 1st of January. Now it's on 31st December. It's only 1 year. So the brought forward here is considered as the RE at the acquisitions. Yeah? So we're already done. I just want to close this one for a while. Chatbot. Maybe I missed that one. Yeah? Okay, if you have anything, please. Okay, so you're going to have here, so the RE when Tuah acquired Kasturi was 35%. So during this time, there is no control yet. Okay, and then at the same date, 2012, Tuah also acquired Jebat 80%. So Tuah have a control 80% Jebat. And then after that, Jebat acquired Kasturi in the year 2008, another 40%. So altogether, you're going to have indirect interest. Here directly, Tuah have 35%. Indirect through Jebat here is another 32%. So now the total indirect interest Tuah in Kasturi here will be 67%. So we said that on 1st of January 2018, Tuah have a indirect controls over Kasturi. Yeah? You can control indirectly control Kasturi. Yeah? Okay, this is information that we have. Okay, and then information here. So investment in 12, you have 500. So another thing that you need to consider here, or information that is important here about the investment in Jebat. Investment in Kasuri here is for that 35%, Jebat 85%, 80%. And then investment in Kasuri here by Jebat here is 40%. You have here the value here is 240. Yeah? Okay. And then information about the shares capital. So that is what you need to know. And then we look at the group policy first before we analyze the additional information. So, okay, the group policy is to measure NCI at the acquisition date based on the fair value consideration paid by a parent's company to acquire a subsidiary company or based on the proportionate shares of fair value of a subsidiary as a whole. So we determine the fair value of the company as a whole. Yeah? So for Tuah to Jebat here, where is that? Tuah to Jebat here. So the value of Jebat here, the shares capital is 500. Okay, we want to find here 500 divided by 0.8 here. So not shares capital, sorry. The investments by Tuah in Jebat was 500 divided by 0.8. So we find that the value for the company as a whole, so the value of the company as a whole here for Jebat here will be 625. Okay, and then if you look at here, the net identifiable asset for Jebat here is a 500 from the shares capital plus 100 from the RE, yeah. So we're going to have here 600. So 600 here, it seems that we're going to have a goodwill of 25%, yeah. So goodwill 25%, 25,000. Okay, that 25,000 here need to allocate among parent and NCI based on 80% portion, and then this one is 20% portion. So, okay, this is the value of Cepat. Okay, the next one we need to find the value of. Okay, we just analyze the information. So the value of Kasturi. Yeah? So the value of Kasturi, we have 240. This one is investment by Jebat. Divide by 0.4 based on the value of Jebat investment 40%. So the value of Kasturi also 600,000. So the value of Kasturi also 600,000. Okay, the net asset. What do you have for net assets here? Yeah. What would be the value of the net asset? Okay, the net asset that we have in a Kasturi here. That's the Kasturi shares capitals. Okay, for shares capital for Kasturi is 500. And then the RE brought forward that we have here is 60. So altogether, you're going to have 560. 560, yeah. So the goodwill sale will be 40. So going to allocate here later on. So thing that we need to know here is to find the value of the company based on this policy. So the value of Kasturi is 600, and then the value of Jebat here is 625. Yeah. Okay, so going to refer back to the things that you need to do here is to show the equity interest. Okay, actually we have done the first part here, do the equity interest. Calculate gain or loss on reclassification of a previously held interest. Previously held interest here is the 30% that you have in Kasturi. Yeah? Prepare journal entry using one stage consideration. One stage consideration here, we prepare the journal entry based on indirect interest. Okay, and then statements of comprehensive income and financial positions. So that is the thing that we need to do. So we analyze this additional information. Okay, Jebat has selling merchandise to Tuah. Jebat to Tuah here means that this one is a upstream, yeah, upstream. Since the date it was acquired in the year 2018, Jebat sold 100,000 goods to Tuah, okay, and the intra-group markup were put in the opening stock. So intra-group markup in opening stock here means that this is your URP brought forward. And then in a closing stock here is the URP carry forward. Yeah? So brought forward 15, carry forward 12. Yeah? Okay, and then in the year 2015, Tuah sold piece of land. So Tuah to Jebat. So Tuah to Jebat here means that this is a downstream sales. Downstream sale. So you're going to have a profit of 10. And then this one was done in the year 2015. Okay, a few years ago. So the things that are going to affect here is your RE, not the profit. Yeah, because it's already done in the year 2015. Now in the year 2018. So you just analyze the information that we have. Okay, from these informations, then we're going to proceed with the requirements here. Okay, so just stop sharing your slide here. Okay, so I'm going to share the answer. We're going to do the answer together. If you have any question, please. Okay, we're going to share with you the answer. Okay, we're going to do this one together. Okay, hopefully that you already done this one. Okay, so the first thing you need to find the complex group structure, like the one that we draw previously for the complex group structures. Okay, we try to look at this one, yeah. Okay, for a complex group structures, we're going to have here, parents here is Tuah. Tuah is a parent, so Tuah, like the one that we draw previously, Tuah have in a Kasturi, we have 35%. And then 80% in Jebat. Yeah? So you have here in Jebat 80%, in Akasuri 35%. This one is in the year 2012. Yeah. Okay, so it means that once Tuah has in Jebat 80% means that the NCI here will be 20%. Yeah. Okay, and then it said that on 1st of January 2018, okay, 2018, Okay, Jebat acquired another 40% in Kasturi. So indirectly, Tua has a control over Kasturi on 1st of January 2018 because Tua has direct 35% and then plus another indirect here from 80 times with 40 from through Jebat here. So you have another 32. So altogether you're going to have 67. Yeah. Okay, so directly for the NCI in Jebat has 20%, and then NCI in Kasturi going to have here. Okay, and Tua have 35% plus Jebat have 40%, so altogether 75%. So means that NCI have another 25%. Yeah? Okay. And then the NCI also have indirect through Jebat. So indirect through Jebat here is 20% here. And then time with 40% here. So you're going to have another 8. Yeah? So altogether for the NCI going to have another 33%. Make sure that when you total up these two figures, it should be 100%. Yeah? So 67% by 12 and then another 33% by the NCI. Yeah? Okay. So is it okay with the first one? Actually, we already discussed this one previously. Yeah. Okay. So the next one, we're going to look at the remeasurement. We need to remeasure the previous investment. Yeah. So the previous investment that you have in a Kasturi here is 35%. So now we want to find the fair value. So the fair value of the company, we already calculate here 240 divided by 0.4. We're going to have here is 600. So 600 here time with a 35%. So you're going to have 210. Okay, 210. And then that is a fair value. Now we're going to compare with the carrying amount. So the carrying amount here is the amount of the COI. COI, where this figure come from, 190 here. You need to refer back to your slide. Refer back to your slide 75. Here they give to you the amount of the COI in Kasturi. By Tua here is 190. Yeah? So 990 here is the COI cost of investment. Okay, and then the cost of investment need to add to the changes in the RE, and also you're going to find the changes in the RE here is 60 minus 25. 60 here is the RE brought forward minus 25. 25 here is RE at the date when Tua has an investment in Kasturi at the date here, which is a date on 2012. Yeah. During this date, the amount of RE here is 25. Yeah? So 60 minus 25. So you're going to have 35. 35 times with 35% here. So you're going to have 12250. Yeah? So add these two figures together. So the amount of the COI has been increased. The carrying amount has been increased by the shares of profit from the RE here. So you're going to have 202,250 compare with 210 here. So you're going to have a remeasurement gain because your fair value here is more than your COI carrying amount. So you're going to have a gain. So this remeasurement gains here is a part of your income statement item or profit or loss item. Yeah. So is it any questions that you have for this 2A and B here? Up to this one? Is it okay? Any of you is okay with this one? Any of you? Okay, so we proceed for the next one. Uh, indirect NCI for Kasturi. Indirect NCI with the Kasturi. Nara? 33%, isn't it? 3 or 5? Kan? Betul kan? 33%. Okay. Okay, so proceed. Okay, the next one we're going to proceed with the journal entry. So the journal entry, since we are using one stage consolidation method, we start from direct. Journal entry direct. Direct here means that between Tuah to Jebat. Okay, between Tuah and Jebat. And then the second one is indirect. For the indirect here is Tuah to Kasturi. Okay, so we're going to prepare this one. Okay, we start with a Tuah first. Tuah Jebat. Okay, Tuah Jebat here is a first that we have here. So Tuah have 80%, so 80% time with 500. RE at the acquisitions here was 100 when you acquired Jebat in the year 2012. So 80% here. And then goodwill on considerations here. We already calculate previously the amount of value of the company for Jebat here is 625. And then the net assets here is 600. So the total goodwill that you have is 25. From that 25 here is 80% to parents, to Tuah, and then another 20% to NCI. So 80% time with 25, going to have here 0.8 time with 25. So you're going to have 20 here. 20 means that NCI another 5. Okay, so goodwill on considerations and then credit investment. Okay, done with the first one. Elimination of the COI. Okay, the second one, we put it a numbering here. So number 1 here. Okay, the second one is to record for the sales of goods. Sales of goods from Jebat to Tuah. So sales of goods that you have here, you're going to debit a revenue and then credit cost of sales. Okay, the second one, the third journal entries here is for the eliminations of the URP. Okay, URP brought forward. So URP brought forward, debit RE. Debit RE, credit cost of sale. Okay, and then the fourth one is the currency URP. URP carry forward. So URP carry forward, debit, sale, cost of sales, and then credit inventory. Credit inventory. Okay, this one is either I just want to mention about this one. Either revenue or sales. So you just refer to the one that you have in your income segment. So the income segment using sales, so you can set both that either sales or revenue. Right? Okay, Naura, okay. Nadira. Okay, so you have here cost of sales and then the inventory. Okay, and then the next one we're going to eliminate for the unrealized profit. So unrealized profit for lands here. Okay, instead of put a profit here, we need to put the returns earnings here. Debit returns earnings. Why? Because this one was already happened in the year 2015. If this one is happened in the year 2018, then you're going to debit profit on land, sales of land. But this one is already in the year 2015, so we're going to put it as a return earning. So debit returns earning, credit others asset, because in the balance sheet they only use others asset. Then you put it as a others asset. Just refer to items that you have in your statements given. So like this one supposed to be sales. Okay, so we're going to have that one for the returns earning and the others asset. Okay, the next eliminations here, remember that you have both dividend income and dividend paid. So dividend paid here by Jebat here is 105. From that 105, there is a portion for parent and then another 20% portion for the NCI. So parents going to receive 84 and then NCI going to receive 21. Okay, done with that one. Okay, so the next one, we're going to look at the journal entry. The next journal entry here is to record for the shares of profit. Shares of profit in Jebat for NCI. So shares of profit in Jebat for NCI here. 150 here is come from profit after tax. Profit after tax. 15 here is the URP brought forward, because this one is related with the upstream sales. Okay, and then minus 12 here is a URP carry forward. Okay, profit before tax plus URP brought forward. minus URP carry forward time with 20%. So you're going to have 3,600. Okay. Then the next one is the eliminations of share, investment by the NCI. Shares capital 20 RE. So RE that we are using here is RE brought forward. Yeah, RE brought forward. Okay, RE brought forward. If you look at here, the amount of RE brought forward here is 170. So this 170 need to minus URP brought forward because this URP brought forward is already recognized in your profit. So you need to minus this URP brought forward 15. So you're going to have 31 here. Okay, and then goodwill consolidation. Remember that we have 25, 20 to parents, another 5 to the NCI. Yeah? So you're going to have, or this is another method to calculate. Yeah? So you're going to have 5 here and then credit NCI 136. So any questions that you have for between tua to cepat? We start with the direct and for one stage method, we're going to start with a direct relationship first. And then after that, we're going to look at for the indirect. So any questions, any different answer that you have for tua to cepat? Any of you have a different answer? Is it okay with that one? Any of you? NCI. In NCI only. Okay, because of what, Naura? Because you don't minus the URP to calculate for the profit. Okay, so now you know your mistake. So better for you to make a mistake than you know. You are going to remember that one, yeah? Okay, so now we move to the next one. We move to Tuah to Kasturi. So Tuah to Kasturi here is the indirect relationship, yeah? So indirect relationship. Okay, so we're going to calculate the company value. So the company value here actually we already calculate here 240 based on the investment by Jebat here divided by 0.4. So you're going to have 600. Yeah. Okay, so from that 600 we need to allocate to the parent. Parent price here is parent in this case here is a Jebat. Yeah, Jebat parents, the intermediate parents, intermediate parents. Okay, so 40%. So 40%, we're going to have 240. Previously held here is by Tua. Tua have 35%, yeah, in direct. Tua have a direct of 35%. So time with this 600. So you're going to have 210. So means that NCI has another 25%. So you're going altogether here, you have 75. So NCI have another 25. So 25 times with 600, you're going to have 150. Yeah? Okay, shares of capitals 500, return profit 60. So the goodwill here going to have 40. Yeah? So from that 40 here, we're going to allocate to parents 40, NCI 35, and then previously held 35, NCI 25. So just time this one, for the share capital time with 40, this one time with 35. This one is 25. So return profit, the same thing. At the end, the thing that we need to focus is this amount, the goodwill. The total goodwill that we have here is 40. From that 40, we're going to allocate to parents here is to Jebat, to Jebat 16. And then to Tua, you have 14. This one is Tua direct, direct. And then the NCI here has another 10, yeah. Okay, so remember this figure. Later on, we're going to use this figure. Okay, so now we're going to account for the investment in Kasturi. Yeah? So investment in Kasturi, the first thing we need to account for the remeasurement gain. So remeasurement gain here going to increase the investments. The investment is going to increase by 20. Actually 20, where to get this 20, 210 is the fair value minus the one that you have in the COI here is 190, so you have 20. From that 20, there is elements of gain or remeasurement 7750, and also from the returns earning 112,250. Where this figure come from? Refer back to your this one. This one. So the changes in the fair value here is due to the return profit. Okay, and there's increased return profit here is return earning that you have here 12, and also you have a remeasurement gain 775 from here. Okay, so this is what you have here. Okay, increase in the value of the investment. The fair value minus the carrying amount here 190. Okay, so from the 20 here, it's come from returns earning 12 and then gain or measurement 7750. Okay, and then we prepare for the shares capital. So shares capital will be based on the indirect interest. Indirect interest tuah in kasturi. Yeah? So indirect interest tuah in kasturi here is 67%. Yeah? Okay, so shares capital, Kasturi shares capital 500, so time is 67. Returns earning also 67%, time is 60. 60 here is the returns earning brought forward on 1st of January. Yeah? So going to have time with 60. So 1st of January 2018 is considered as the acquisition date. Yeah? So you're going to time with 60, 32. 32. Kenapa nak guna 32? Laura, why you want to use 32 here? Laura, can you just mention that one? But I just means that can you just speak out, voice out so that indirect focus to read? Okay, if you have 32, means that that one is not, you don't have to prepare a consolidated financial statement, but you're going to use both direct and indirect. Yeah? But we call this one as a indirect interest. Okay, means that you have a control over this company through direct plus indirect. So then you're going to have a control. Yeah? So we're going to prepare elimination consolidated financial statement when we have a control. So if you have 32, you don't need to prepare a consolidated financial statement, yeah? Because this one is only less of, you don't have a control. So the purpose of preparing a consolidated financial statement is when you have a control. So your controls here, you're going to calculate based on a direct and indirect, because Tua only can control Kasturi through Cepat. Yeah? So we're going to include both direct and indirect. Yeah? So Tua control Kasturi through Cepat. Indirectly, Tua control Kasturi through Cepat. Yeah? Okay, so we're going to put it as a 67%. So RE here will be 67. Okay, for the NCI here, so remember that for the NCI here, we need to exclude. Okay, we need to exclude. How much we need to exclude here based on NCI percentage in Jebat time with Jebat COI in Kasturi. Because we need to eliminate NCI in intermediate parents. Yeah? So NCI in Jebat we have 20%, and then time with cost of investment of Jebat in Kasturi here is 240. Yeah? Cost of investment Jebat in Kasturi 240. Yeah? So we're going to time this one. We need to eliminate and we need to exclude. So that's why we need to rabbit because we want to exclude 20% time with 240. So we're going to have 48. Okay, and then you're going to have goodwill on consolidations here. So for goodwill on consolidation, you have to be careful. Yeah, 14 here is from your direct, and then you from that 16k here is the amount of goodwill in Jebat, but parents or tua only control 80%. Okay, tua only control 80% in Jebat. So this amount here need to time with 80%. So 80% here is a control of tua in Jebat. So the amount of goodwill here will be 76,800. So the amount that you have here is 16 time with 80. Yeah? So you're going to have 12,800. And then plus with 14 here. So 14 here is from your 30% interest. From 30% interest. This one is through Cepat. You get a goodwill through Cepat. Okay. So you're going to have 26,800 and then credit investment 450. I just finished with the journal entry. If you have a question after this, okay, the next one is about the shares of the profit. Shares of the profit for the NCI. NCI have 33%. 33% time with a profit for the year, profit after tax. Profit after tax. So you're going to have 9.9. Okay. And then the last one, we're going to record for the NCI. So NCI shares capital 30%, the same as this one. Okay, goodwill on consolidations here. So the goodwill here, total goodwill here is 40. Okay, so you need to minus goodwill to parents. Yeah, goodwill to parents that you have here is from this amount 26. Okay, which is 14 plus 14 here is from the direct 35% plus 12,800 here is from indirect. Yeah, 14 plus 12.8. So you're going to minus 26,800. Yeah? So you're going to have 13,200 and then credit NCI 198. Just put a numbering for your journal entry later on when we prepare the statements, then you know where the figures come from. Yeah? Okay, any questions that you have in investment between indirect relationship between Tuah and Kasturi? If there is any questions there, any questions that you have here? Ada salah lagi tak? Naura ada salah lagi tak?
Ada doktor, just kena buat balik rasanya.
Okay, the rest, what about the rest? If there is any questions, Puah, is it okay with that one? I can remember only a few here. Okay, so we proceed. So we proceed with the statement. So you put a numbering for this one for the journal entry. Later on, when you prepare the statements here, easy for you to understand this one. I just put the numberings. Later on, you can know where that figures come from. Yeah? Okay. Now we're going to prepare for the statements of income statement. We start with the income statement first. Yeah. Okay. For the income statements, the one that you have here, hopefully that you can see this one a little bit small here. Too big. Okay. So we're going to look at here. For the revenue that you have here, you just total up that three company, Tuah, Cepat, and Kasturi. And then minus 100 here is for the intra-group sales here. Intra-group sales here is journal entry number 2, based on numbering that I put previously. This one is intra-group sales, so you're going to have 1.4. Cost of sale, total up that three company. This is the journal entry number 2. Okay, and then this one is related with the IURP brought forward. Okay, this one is an entry number 3. And then this one is a URP carry forward. Yeah. Journal entry number 4. So you're going to have 697 total up. Okay, and then one more item. Remember that you have gain or remeasurement. Actually, if you want to prepare a proper format, you need to put under others income. Other income, you're going to have put it under as a gain on remeasurement. Because gain or remeasurement is going to increase your income on remeasurement. A parts of your income statement item. So you're going to have 7750. Okay, less operating expense, just total up for that three company. Taxation also the same thing. So you up together and then minus the tax. And then from the profit from taxation, you have 330,750. So from this amount, need to allocate to parent and NCI. So the first thing we need to look at how much that we allocate to NCI. The rest will be to parents. Okay, to NCI 30.6. 30.6 here is the amount that you allocate from Cepat. So Cepat here is journal entry number 7. And then this is the amount that you allocate from the NCI received from Kasturi. Kasturi here is a journal entry number 11. You can refer to that one. 30.6 from Cepat, profit from Cepat. Okay, and then this one is profit from Kasturi. So you're going to have 4,500. So 33,330,750 minus this figure. So amount that left to parents here will be 290,254. Okay, so that is your income segment. Okay, the next one we move to your financial positions. Okay, financial positions here. Going to look at others asset. Okay, so others asset that you have here, just total up for that three company. Minus 12. Minus 12 here is your URP carry forward from the inventory. Yeah? So because we don't have a specific item for inventory, put it under other asset. This one is from the inventory. And then 10 here is from land, URP from land. Yeah? So going to have here is general entry number 5. This one is number 4. Okay, so we have to have 3, 5, 1, 2. Goodwill on consolidation. This 225 here is from Jebat. And then this is amount from when you total up here is 40. Yeah? 40 here is from Kasturi. Yeah? So this is a portion for parent, portion for NCI, parents and NCI. Yeah? So you're going to have 65. Yeah? Okay. And then you have shares capitals. Okay, so shares capitals, the one that you have here, total up that three company together. And then we're going to, I just close this one for a while, check box here. Okay, shares capital total up, and then this 40 here is from the one that you have from Jebat. Okay, for parents. Okay, and then this one is for NCI. For NCI in Jebat, and then this one is for Kasturi. This two is for Kasturi. So journal entry number 1 here, number 1. This one is journal entry number 500 here. 100 is in number 8. This one is number 335 here, number 10. And then 165. 165 is number 2. Okay, so check all the journal entries. Okay, so you have 1 million return profit. Later on, I'll explain about return profit. We look at the NCI here. NCI 136. Okay, 136 here is come from journal entry number 8. Yeah? In Jebat. In Jebat. 3600 here also from Jebat. Shares of profit. Okay, and then minus 21. Okay, 21 here is from a dividends. Dividends that you receive. So journal entry number 6. This one is journal entry number 8. This one is journal entry number 7. This one is a dividend. 9.9 here is shares of profit in Kasturi. So profit in Kasturi here is journal entry number 11. 14, 48 here is journal entry number 10. Number 10 here is relate with the eliminations. The NCI in intermediate parents, and then 198 here from journal entry number 12. Okay, so that is what you have for the NCI liability, just total up. Okay, now look at the RE here. So for the RE, where is this figure come from? For the RE that we have here, so RE brought forward, we have total up for that three company. Minus 15 here is the journal entry number 3. Your RP brought forward, yeah. Minus 80. So what is this 80? 80, what do you have for this 80? 80 here. Where is the 80? Okay, 80 here is in the entry number 1, yeah, based on consideration. 40.2. Okay, 40.2 here is a general entry number 10. Relate with the Kasturi, yeah, the Kasturi here. Kasturi, this one is Jebat. 12.25. 12.25, where this figure come from? 12.25. Item number 9. Number 9 here is related with the increase in the value of investment. Yeah? Number 9. So we're going to have here RE credit. Credit means that you need to plus. Minus 10 here is from the URP of land. Yeah? URP of land here is item number 5 here. Okay, minus 31. Do you have a minus 31 here? So minus 31 here is item number 8. Yeah? Number 8 here is your Jebat, yeah? The one that you allocate to the NCR. And then minus 19.8 here is item number 2. So you're going to have your RA brought forward here to 56 to 54. Last profit for the period is profit for parents. And then minus a dividend. Dividends here 170 plus 105 here is from Jebat. And then minus, this is the eliminations that we have here. Eliminates here. At the end, you're going to have 105 here. So at the end, the figures here is only 170. So you're going to have RE carry forward will be this figure. Okay, so any questions that you have for these examples? So that if you understand this one means that you can answer for your tutorial's questions. Any questions that we have here? Any questions? Any of you have a questions? Please, I can't see from the chat. If you have any questions, you just voice out there because I put it in the chat box. We're going to see some of the information that we have here. Tutorial question more difficult. Okay, so that's why you need to try. So you try to make a mistake, then you're going to learn from your mistake. Is it okay, Po? Okay, you're going to learn from your mistake. That's why your tutorial questions will be difficult. Huh? Okay. Any questions that you have here? Any questions? So means that we are done with chapter 3, yeah? Yeah, I'm still waiting. If you have any questions, yeah, I try to find my tutorial questions. Okay, the next thing that you need to do here is you need to submit your tutorial by 5th of May. And then another thing here is your first project. Yeah? Project 1 will be on the 6th of May, isn't it? Okay, so that is the thing that you need to do in year time. Yeah. Okay, so any questions that you have here? If I want my tutorial questions. No questions, eh? If there is no questions, we're going to proceed with your cash flow. Okay. So we're going to proceed with cash flow. So I just stop sharing this one. So we're going to proceed with your cash flow. So I need to find the notes. While I'm searching for the notes, if you have a question, please. Yeah? Hopefully that you understand this one. Yeah? So I'm going to look at for your cash flow. Okay, so we're going to proceed with cash flow. Sure that you have a note with you. Cash flow is a simple. So starting from cash flow, a little bit relaxed as compared to chapter 2 and chapter 3. Yeah. Just need to delete this one for a while. Okay, so ready with the notes. Just want to delete this one. New chapter. New chapter on cash flow. So what do you have now? So just to show you. Where is my cash flow? Do you see now? Is it the cash flow notes? Okay, cash flow notes, isn't it? Do you have with you now? Nothing. What about now? Okay, cash flow notes. Okay, the first few slide here, not few, maybe 10 or slide here is about the revisions only. So the thing that we're going to focus here on the consolidated statements of cash flow. Okay, so going to a little bit relaxing for the cash flow. Okay, so we're going to do this one slowly. We have half an hour to cover for this one. Hopefully that parts of the notes we can cover so that for the next class we can have example for this one. I think that we have example for this one. And then when I'm going to check later on. Okay. So we're going to look at the consolidated statements of cash flow. So this one is standard that we referred here is 107. Yeah. Okay, so the learning objective here is going to explain the rationales of the cash flow reporting, why we need to have a cash flow reporting, more on the advantage of having or the usefulness of the cash flow reporting. Okay, requirements of statute of the accounting standard and segments of cash flow, including related transactions for the groups, prepare a consolidated cash flow statement. Yeah. Okay, so the theoreticals, okay, to have a statements of theoretical consideration, this one is only the, just want to skip this one a little bit. Why we need to use the theory for the statements of concession technique of preparing a consolidated financial statement. We have two methods here. Either we are using a direct method and then the other one is a indirect method. So most of the questions we are referring to this the indirect method. So most of the time we are using this one because direct method is a little bit complicated. This indirect method we need to do the adjustment from your P&L items here. Okay, and also the income and the financial positions item. Okay, so prepare the consolidated. So why we need to prepare here? Because you want to provide information about the cash receipt and the cash payment. So the things that relate with the cash flow is anything that relate with the cash. Cash receipt, or you only focus on two items, cash receipt and cash payment. Yeah, payment, cash or receipt. So provide information about operating, investing, and financing. So for the cash flow statements, we're going to have three different elements or three segments for the cash flow here. Either that one is for the operating related with your item in your income statement. Okay, investing is related with your fixed asset. Okay, fixed asset, and then the other one is financing. Here is changes in item that relate with the liability and equity. So we're going to focus on that three elements: operating, investing, and financing. So when we prepare estimates of cash flow, we're going to segregate the items, or we're going to segment the items into three different segment. Yeah, operating, investing, and financing. Yeah. Okay, so going to answer the question where the cash come from is referred to the cash receipt. Where this cash come from? What was the cash used? So this one is related with the cash payment. Okay, and then the third one, what is the changes in the cash balance during the period? So changes in the cash balance during the period is the difference between cash at the end carry forward minus cash at the beginning. Cash at the ending minus cash at the beginning. So we're going to look at the changes here. So it will be the changes. So the benefit of using having the cash flow statements here is going to evaluate the changes in the net asset company. So user can evaluate the changes in the net assets of the company and then assess the ability. Okay, assess the ability of the company to generate cash and cash equivalents through the using of their asset, use of the asset, and then try to enhance the comparability of the reportings of operating performance by a different company. So it's actually when we use the income statement, the comparison between company is less as compared than we using a cash flow statement, because this cash flow statement, but some of the item in the income statement is like the one that are not actual happened yet, but we already recognize it. But for the cash flow statement, we only consider about the cash receipt and the cash payments. Okay. So the statements of cash flow is prepared using cash and cash equivalent as it basis. What is a cash equivalent? Cash, you know about the cash, the money, bank, okay, so your bank, or and also your cash in hand. But normally we are on for a big company, we only have cash in bank, yeah. And then for cash equivalence here is example of a cash equivalence here is a short term or highly liquid investment. So short term, it means that short term here is less than 12 months, and then this investment can be sold immediately. So that one is considered as a highly liquid. Yeah? So these investments can be considered as a cash equivalent if this investment fulfill these two criteria. The first one short term, and then the second criteria should be highly liquid. Yeah? So highly liquid here means that you can convert the amount of the investment to the loan amount of cash. Okay, and then this investment is also so near to its maturity date, which the market value is relatively not sensitive to the changes in the interest rate. Yeah? So the investments here that can be considered as a cash equivalent when the investment is a short term, and then easy to change to cash. You can convert to cash. Okay. So the statements of cash flow here, we're going to use standard 107. That 107 is focused on the statement of cash flow. But so for the preparation of consolidated statements of cash flow, we still refer to the same standard because it's not much different between the consolidated and the statement of cash flow. Because for the consolidated, we need to add a few extra things in the statements. Okay, the process to prepare the C statement is similar for an individual's company. The statements of cash flow, consolidated statement of cash flow should report cash flow from operating, investing, and financing. So the format for the cash flow statement and consolidated cash flow statement is similar. So we're still using the same standard. Okay, for operating activities here is related with the cash effect of the transaction that create revenue and expense. So for the operating here is cash that are related with the revenue and expense. Yeah? The indicator here is internally generated cash flow from operation. So it's include in the cash receipt of goods when you sell goods or provide a services, receipt from royalty, fees, commissions, and other revenue, payment to supplier, payments to the employee, payments for the insurance, and claim for others' benefits. So interest element may be classified as an operating activity. Okay, we have to be careful with this one. May be classified. Interest elements here may be classified. Okay, interest expense or interest income may be a part of the operating activities. Okay, and then there are two methods to prepare for the operating activity. So for cash flow statement, we have two methods here. That two method, the difference here is only for the operating activity. So to calculate for the okay, if you look at the statement of cash flow, going to have operating, investing, and financing. We have three segment or three activities. Financing. Okay, so for the operating here, there are two methods to calculate for the operating or to find for the operating. The first one, you have a direct method, and then the second one, you have a indirect method. Okay, so for a direct method, so you're going to have a major class of gross receipt and gross payments. Yeah, this one is preferred by the standard examples here. You're going to have from the operating, you have received from the customer. So receipt from customer is related from sales and also your account receivable. Okay, and then paid for merchandise here is related with the purchase, or sometimes we use a COGS, and also accounts payables here, and then paid to the employee, paid for the interest and the income tax. So this is for the direct method. Okay, another method that we have here is indirect methods. Okay, for indirect methods here, we're going to make an adjustment. Okay, we're going to make an adjustment from the profit or loss before tax. Profit or loss before tax in the income segment is adjusted. You need to adjust here for the non-cash nature. So means that if you have a depreciation, provision, deferred tax, profit, retained and associates here, this is relate with a non-cash nature. So we need to make an adjustment either with plus or minus. Yeah, adjustments here is plus or minus. And then the other one is changes in the stock, debtors and creditors. So changes, the next one is a changes in current asset and current liability. Any item that you have in a current asset and current liability, so we call this one as a changes in working capital. Okay, so we're going to look at the focus on the difference between net income and net cash flow from operating activities. So most of the time we are using this indirect methods here because we already have the income statement. From the income statement, we need to make an adjustment. So the adjustment, the first adjustment is related with a non-cash item. The second adjustment here is adjustment for the working capital. So working capital is referred to the changes in the current assets and current liability. So means that the item that you have in your statements of financial positions. Yeah. Okay. And then we're going to look at the examples here. So this is example of your indirect method. So we start with a profit before tax. Profit before tax, make an adjustment. So adjustment here, shares of profit in associate, we need to minus it. Minus because there's a profit from associates in intra-company. Yeah. Depreciation, we need to plus. Plus because there is no cash involved. Need to plus back because we minus from your as one of your expense. So we need to add back for depreciation. And then the same thing for your bad debts and doubtful bad debt allowances. So you need to add back this one. So plus this one plus. And then you have operating profit before working capital changes. So working capital changes here is referred to the changes in your current asset and current liability. So for the increase in a current asset, okay, you need to minus. Okay, decrease in the current asset, we need to plus. Increase in the current liability, we have to plus. Decrease in the current liability, we need to minus. Okay, why the increase in the current asset, we need to minus here? For example, here your account receivable. Okay, account receivable here 10. Now it become 15. So increase by 5. So increase by 5 here, there is no cash involved here. So increase here means that there is no cash involved, so we need to minus here. The same thing, let's say in your loans, short-term loan. Short-term loan, for example, you have a 10. Now the balance become 15. So increase here, increase means that you have some more cash added. So added here, so you need to add this one plus. So this is, you just remember this one, the key things that you need to do. If there is an increase in the current asset, we need to minus. Decrease, we have to plus. Current liability increase, plus. Decrease in the current liability, you have to minus. Okay, so this is what you have. And then you're going to have tax paid, okay, interest paid, okay, before that, interest paid, and then tax paid. You're going to have net cash flow from operating activities. Okay, so the next one you have the investing activities. Okay, for investing activities here is cash flow represent the extent to which expenditure relate with a long-term asset. Okay, long-term asset. Any expenditure relate with a long-term asset has been made for resources intended to generate future income and cash flow. For examples here, when you acquire a PPE or any other asset, okay, cash receipt from the disposals of your PPE, cash receipt from sales, cash payment to acquired, and then cash payment to acquired investment. Investments here is also a part of your investing activity. As an investment here, either investment is subsidiary, associate, or JV. Yeah? And so once you have investments here, you may have an acquisition and you may have a disposals. Okay, for your fixed asset or long-term asset here, for the investing your long-term assets here, including your acquired PPE, okay, disposed PPE, okay, and then acquired investments or disposed investment. So acquired investment or disposed investments here is including subsidiary, associate, and TV. Yeah. Okay, so that is what you have. So for investing here, focusing on the fixed asset, including the investment. Okay, the next one you have financing activities. So for financing activities used to predict claim of future cash flow by providers of the capitals to enterprise. So changes in the size and compositions of the equity capital and the borrowing of the enterprise. So equity capital here is referred to your equity, and also borrowing here is a long-term liability. Yeah? It involves long-term liability and equity in a balance sheet. So for financing here is long-term liability plus equity. So example that we have here is cash proceed from the issuance of shares in others equity instrument, cash payment to the owner to buy back. Okay, cash payment to the shares buyback, cash proceed from the issuance of debentures or others loan or notes, or then the other one is cash payment for the amount borrowed. So this is example of the liability and equity. Long term liability, because short term liability is under current liability. For financing here, we're focusing on the long term liability and equity. So for operating here is revenue and expense together with a current assets and current liability. For investing here is long term asset. For the financing here is a long-term liability plus equity. Okay, so that is the things that we have here. Okay, now this is when we start with the consolidated. Yeah, previously it's only the introductions only. Okay, for the consolidated statements of financial positions, segments of cash flow here, in order to prepare the statement, the item from consolidated statements of financial position and consolidated statement of P&L and others comprehensive income need to be used. It means that you should have the consolidated statements of profit or loss, and then you should have a consolidated segments of financial position. Okay, from these two segments, after you already prepare these two, then you can prepare a consolidated statement of cash flow. Okay, because you want to use the information from these two statements to prepare a consolidated statements of cash flow. Not to consolidate statements of cash flow by individual company. So we're not going to consolidate statement of cash flow of the company. So let's say parent statements of cash flow plus subsidiary statements of cash flow. We're not going to do this one. Okay, we just want to use informations that is from the consolidated financial statement and consolidated from the profit or loss and the statement of financial position. From that two statement, after we already prepared that two statement, then we can proceed with the consolidated statement of cash flow. However, if there is no other way, then the group internal cash transaction must be eliminated to avoid double counting cash. But we need to eliminate the internal group cash transactions. Okay, so there are few extra things that we need to focus here. So please be careful with that. This one. This one is you do not have this one in a statement of cash flow. You only have these four items here in a consolidated statement of cash flow. The first thing that you have here is relate with the NCI. The second thing here is relate with the investment in associate, acquisitions of a subsidiary, and the disposal of subsidiary. So we need to focus on this four things, which is extra things that we need to consider in the consolidated statement of cash flow. Okay, for the first one, NCI, we look at the NCI. So NCI interest here will be changed. The NCI balance will be changed due to the changes in the current year profit, NCI shares of a current year profit, and then dividend paid by a subsidiary to the NCI. Only two items going to affect the NCI: current year profit and then dividends for the paid by the subsidiary to the NCI. Okay. However, only transaction will affect cash flow of the group will be included in the cash flow statement. Okay, for transaction A, which is the current year profit, Okay, in subsidiary, there will no effect to the cash flow statement, yeah, because there is nothing to do with cash or cash equivalent. The one that affected here is only a dividend. So we need to focus on this one. For the NCI here, we're going to look at the dividend paid by the subsidiary to the NCI. Only the second item that going to affect the cash flow statement for the NCI. Yeah? But for the NCI, the affect cash flow statement is only the dividend paid. Yeah? Okay, so for the transaction B, when there is a dividend paid by the subsidiary, it going to result the outflow of cash because dividend paid by subsidiary, then it going to be included in the consolidated statements of cash flow. So only item B. So once paid by subsidiary, going to pay using cash. So they're going to involve cash. So going to include as a part of the statement of cash flow. So remember that the cash flow statements here is anything that relate with the cash. If there is no cash effect, this is not a part of your statement of cash flow. Okay. So this is what how we're going to find the dividend paid by subsidiary here. Can be calculated here. So better for you to use the T accounts here. So the T account, we start with the balance brought forward plus a profit plus an acquisition and then minus the NCI dispose and then the balance carry forward and then you can find the amount of dividend paid. So to calculate how much the dividend paid, we are using the T account. It's a simple set. So this is what you have for the NCI. Okay, for examples here, this is a partials of the statements here for A and B. Okay, and then the statements of the comprehensive income for A and B. So you have profit before tax. Here is the thing that we need to focus here is on the okay, you have a profit 6 to 5 tax, and then this is segments of comprehensive income for A and B. Yeah? A and then this is a B. So B is a subsidiary here. Okay. This is a subsidiary. Profit after tax, shareholders attributable to the NCI. Okay. And then we are going to have here the thing that we need to focus for the NCI here is only the dividend paid by the subsidiaries. Okay. So the profit here does not have any effect. So this one does not have any effect because there is no cash involved. The thing that we need to focus here is a dividend that is paid by the subsidiary because the dividend paid by the subsidiary will affect both parent and NCI. Yeah? So now for NCI parts, we're going to look at this one. So the NCI has a portions here since the parents have 70%, isn't it? Okay, parent has 70%. So it means that the NCI has another 30%. Yeah? So the thing that really going to reflect the segment of cash flow here is only the dividend paid. So dividend paid to the NCI here, the total amount of dividends here you have 12.5. So for 12.5 here to 70% to the parents and then another 30% to the NCI, to NCI. So the one that we're going to focus here in this one, the one that affect the NCI here is only 30%. So the 30% that we have here is a dividend paid to the NCI, the amount here will be 3.75. So we need to minus from that statements of the cash flow. So you need to minus the NCI 375 for the dividends that is paid to the NCI. So we put it under financing activities because dividend pay is related with the financing activities. Okay. So why this one is related with the financing activities here? Because NCI here is a part of your equity items. So we're going to put it under financing activities. Okay, we just proceed two more. The other one you have investment in associate. So investment in associate also going to be affected through the changes in a currency of profit and also the dividend received from the associates. However, the first transaction does not affect any cash. So only the dividend received here going to affect cash. So we only consider about the dividend received from associates. So for NCI, also dividend received. Okay, dividend paid to NCI. Okay, and then for associate is a dividend received from associate. Yeah? That one is only the things that are going to affect your cash flow statement. Yeah? So dividend received from the associate can be calculated as follows. So this is what you have, dividend received. So investment in associate brought forward, shares of profit going to add together, and then if there is any additional investment, minus the disposal of investment that you're going to have balance carry forward. So the difference that you're going to have here is a dividend received. Yeah? So that is one thing. We try to look at examples that we have here. Shares of profit in associate 17.5. There is no effect here because there is no cash effect. So there is no effect. So we're going to look at the next one. The one that you have here is dividend paid. Okay, dividend announced by the associate here is 12.5. From that 12.5 here, going to allocate to parents. Parents. You're going to look at here. From this amount, profit before tax that we have here is 642.5 less a non-cash item. So non-cash item here is shares of associate profit, portions of the net profit. And then for the cash flow from investing activities here is dividend received from associate. So dividend received from associates here is 2.5. 2.5, where to get this 2.5 here? How many percent that you have in that associates here? We assume that you have 20%. So 20% times with 12.5. So you're going to have 2.5. Okay. Okay, we need to lessen the amount of profit before tax with the preparations of the associate profit amount because the profit is not a cash. So we need to add back this amount because the shares of profit from associate is not a cash item. So we need to, before this, to get a profit here, profit, we're going to plus shares of profit from associate. So now, when we make an adjustments here, we need to minus adjustment because it's not related with the cash. Dividend received from associate will increase the group cash. Thus, we will add up as a segments of cash flow. We put it under investing. Why we put it under investing here? Because investment in associate is a part of a investment item. So investment here is a part of your long-term asset or fixed asset. Yeah? That is what you have for associate. Okay, so this is what you have for a direct method. Okay, direct method, and then the other one is indirect method. So for a direct method here, the things that we need to make an adjustment is only for the operating activities because only for operating activities you're going to have both direct and indirect method. Indirect method, we make an adjustment from the profit. So profit need to minus shares of associate profit because that's what this one is not related with the cash item. And then we have one more item here is investing activity. This one is indirect method. But for the direct methods here, we only have one item here, which is which the thing that affect here is only the investment. Yeah? So you're going to have a dividend received from associate 2.5 here. Okay, by using direct method, you do not have to bother by the expressions of the share profit in the profit before tax amount. You can directly add the amount of dividend received from associate under the cash flow from investing activity. So for a direct method, we only have under investing activity. But for indirect method, we're going to have both. One is for the operating activity. For the operating activity, you need to add back the amount of shares of profit. And then we're going to have here another items here under investing activities. We're going to have a dividend from associate. That is a difference between direct and indirect methods. Okay, so done with this one. Okay, can I just proceed with this one? Or we just skip for the next class? It's already 12:23. So for the next class, we're going to continue with that slide 28. I'm not sure at the end of your note, is there is any example questions? You have example question. Okay, we're going to do this one together, but you can try. Okay, maybe you can try for the next one, which is the Jatra. Okay, for the next class, we're going to continue with slide item number 3, item number 3, which is relate with the acquisitions of subsidiary. Oh, you don't have the examples at the end of your notes? Can you check that one? What? At the end of your note, do you have this one? At the end of the notes? No, so. Which one did I give you? Oh, I know. Can you check the latest notes that I provide in online? I think that you already upload the notes. I think that I put a notes, and then after that 2 days later I realized that there is no examples, and I already upload the new notes. For those who just download the latest note, you have that one. So Puah, the note is the same. You can use that note, but for the new one, just find for the examples only. Can you check for that one, Puah? I already upload the latest one. I know that you are the one who download the notes a day after I posted the first one. Okay. For those who just download the notes, then you're going to have the example. So for those who don't have example, please check your note. If you don't have the example, please refer to the latest note that I already upload that online. Just find for the example. The rest of the note is similar except for example that we have here. Either you use the old one or use the new one. The note is similar except for the examples only. Okay, you can have that question. So try to look through the examples. If you have time, try to do that one. Yeah. But we're going to discuss together in this coming class. So this coming class, we're going to continue with item number 3. Yeah. Okay, so going to stop this one. I'm going to scan for the attendance for those who are not yet scanned for the attendance. Okay, for those who have a class, you want to leave the meeting, can leave the meetings now. Okay, so just want to share the attendance only. So for the next class, we're going to continue with the slide 24, 23, 24. 24 done. 27, yeah? Okay, so going to meet the next class, yeah? So please have a look on the